The markets, what is happening with them? We had the worst January the Dow did since 2009. Yesterday, the Dow down 326 points. Today, seems like it's gotten its balance, but is this a moment to consider escaping the markets? Ivan Sachs is a financial strategist with Kingsley Advisors. That's KingsleyAdvisors.com. Ivan, thank you for joining us on WILS.
With pleasure, Michael. Yes, very interesting times we're living in right now. So we've certainly seen the market take a really big high run-up for the last couple of years, 2-3 years, with the money supply being so free and with interest rates being so low,
right,
that sometimes things that go up need to come down a little bit just to get themselves into proper perspective. So it really shouldn't be a surprise.
It was a 30% gain that the market saw last year. Have we seen any real true correction in the last several years?
In the last several years, I don't think in the last several years, since 2008 and that, people were very despondent with the hard crash that we had. And then with the easing of money, people just couldn't believe how low the money level went. And that you remained there for so long, and then eventually you don't have any money coming back on your CDs. Mm-hmm. Interest rates are so low that you had to find a place to run to, and everybody ran to the markets. And now with the tightening of the money supply, supposedly, just in terms of talking, right, people are anticipating that interest rates are going to go higher, and people have got a herd mentality, so everyone starts getting scared and heads towards the exit door.
So wait, are we now seeing this beginning, the jittery beginning, I should say, of what might be a real correction this year?
Mike, I still think that the economy is moving forward. When you look at housing, which has been a big supporter of the economy, there's only been a 20% recovery from 2008. So even though we've had a lot, we've seen quite a bit of recovery in certain segments haven't even begun to take off yet. So I think there are still quite a few areas of growth. There will be a rotation out of certain sectors that have really got bubbly, let's say the high-tech area, and people will probably start going into areas that haven't been as bubbly as those. Okay,
give me some of those. You say the high-tech area has seen real recovery. Which areas have not?
Well, if you look at the worst sectors, the housing industry clearly has gone up quite a bit. But then if you look at, let's say, the resource sector has been killed. Resource sector being like the commodity sector, let's say if you looked at gold, that's probably the most hated area right now. And those areas have gone completely off because people have just taken on any kind of investment that would be going up in value. And that's clearly been the technology area. The areas that haven't really gone up are some manufacturing companies. There's quite a few companies that have been ignored. But the Dow sector obviously has gone up a lot. The ones that everyone knows.
Right.
All of those have gone up.
So the January we had, this worst January since 2009, and then starting February off yesterday with a 326-point drop. Where do you see that leading us in the next several months?
Mike, if I knew, I'd be super wealthy.
Right, but
I really don't know, but
give me your gut level sense.
Yeah, my gut level stuff is that we really are going to see a rotation where people are just going to start rotating into something different. I don't see interest rates going up that rapidly, but people are scared. They suddenly think it's going to be like 5 or 6%. The 30-year Treasury note is still so low that we're still going to have people going into the market. I don't see the market crashing completely at all.
Okay.
I still see people taking that as a way of investing in the market itself. They'll just rotate out of the high sector into lower sectors that haven't been valued properly yet.
How long have you been involved in the markets yourself?
About 33 years.
Okay. So when the corrections come, like the one in 2008, have you yourself had a sense that something was about to happen?
Yes. Mike, yes and no. It's always like when you've got 20/20 hindsight, you always seem like you're clever. But the truth of the matter is, you mature over 33 years. When I think of myself 33 years ago on how I would respond to the way the markets are going right now, it's very different from where I am right now. You do have where you mature, and your emotional bent isn't as highly strung as what it was when you just initially got into the market.
Mm-hmm.
So I would say, like, over time, when you get a little bit more mature, you realize that cycles do come, markets do go up, so markets do go down, and there's probably a saying that's pretty applicable here. I think it was King Solomon who had it on his ring, where it said, "This too shall pass," and things do pass.
Right, we're at 15,445 on the Dow right now. 6 months from now, do you think we're going to be very far off that number?
I hate to tell you this, Mike, and I know the audience is waiting for an answer, but I'm going to say I just don't know. I'm really sorry. I just don't know where it's going to be. It could be higher. I don't see it being like, let's say, below 10,000, but I really can't guess because I really don't know where. I focus more on individual companies, and that's why I'm not going to be probably a prognosticator that's probably going to be able to give you the answer.
Well, give me right now, if you're going to invest in one or two stocks today, what would they be?
Oh, for sure. I would say not the actual individual companies because I can't say that, but I would definitely say that I would look at the resource sector, which has really been kicked down. Like if you look at the gold industry.
What part of it would you be buying gold right now, you're saying? I
wouldn't buy the physical gold.
Uh-huh.
I would buy the actual gold companies because they're down much more than actual physical gold itself.
Okay,
gold, like for example, gold has gone down 30%, let's say 34%, let's say from 1,900 down to 1,200. But the actual gold companies themselves are down about 60 to 65%, even 70%.
Okay, that's a good spot. You have another recommendation?
The other areas is like heavy industry, like construction companies. There's quite a few construction companies that haven't really even benefited at all from the I'm thinking of a company or two in the highway areas where there's a lot of potential work that could potentially come up, but they are so deeply discounted right now. Almost, I know of a few that are down like maybe 40 to 60% from where the actual net asset value, where you could liquidate it at.
Heavy industry.
So there are some. That could be an area.
Heavy industries and resources, some areas to consider. Ivan Sachs, financial strategist with KingsleyAdvisors.com. Ivan, thanks for your insight tonight.
Thank you, Mike.